All right, guys, welcome back to the Independent Investor Channel. This will be a portfolio review of the self-directed account number 2. You guys will appreciate the transparency on jumping into the account and really showing what's possible as a self-directed investor. This is one of the 2 accounts that have been tripled over the last 5 years. Just to kind of give you an insight on how value investing doesn't need to be boring. At the end of the day, the game is about money, okay? And I think a lot of people approach investing in a lot of different ways and escape the very nature of why we're investing, and that is to make money. Now, the irony on the Independent Investor Channel is that's not our sole motivation. We tend to take more of a strategic approach to the market and contend that the designation that you're able to put over your account and your ability to tax protect and wealth preserve dollars is far more significant than the actual holdings that make up your account. Hope you enjoy. That is indicative in this self-directed account number, Roth IRA number 2. Hope you enjoy this review, guys. I'll kick you into the account now. All right, so this is portfolio review number 2. This is the self-directed Roth IRA account that I've built simultaneously with the other one. So if you watch these individually, you're only getting at most half the story. I've got 3 taxable brokerage accounts and then the TSP as well. So it's kind of a combination of a comprehensive portfolio. This is a large aspect of that, being that it's my one of 2 individual Roth IRA accounts, and they both are self-directed in nature. So the holdings in here are not subject to any type of fees at all. It's built to complement the other portfolio as well. So this is built with a couple strategic goals in mind, 3 to be exact. The first being diversified base. And I gained my diversified exposure through ETF products from Vanguard. Also some dividend growth exposure in this, and finally a little bit of growth. So those 3 things you're going to see are realized in this portfolio. I'm going to run down the list for you quickly so you can get an idea of some of the changes. Most of this has not changed at all. It's just been allowed to continue to work as we've been able to generate a lot of good trading profit in here over the last few years. A lot of these positions have been taken with house money, as I've been able to generate some profit within the account and actually accelerate the growth that's represented here. So anyway, starting with AbbVie, this is a nice position here in the healthcare sector. Nice dividend payer here. And then right below it, that's a fairly new position, that of which I don't think I've disclosed through the review. So right below it with Bristol Myers Squibb, a nice strong position there at 50 shares. That just took off right away after I bought it. So not too shabby. You like to see that when you enter into position. I didn't get the best entry on Bristol Myers. I did trade it once in the low 50s. Should have just held the stock. It was with significantly less, to be honest with you. But needed to increase healthcare exposure. Did that through Bristol Myers. Cisco Systems has been really a terrible performer this year. Really disappointed. One of those stocks that you can buy and own forever, and I'm fine with that. This is really the small aspect of technology in this portfolio, which is fine. We'll continue to earn the dividend on this one and live to fight another day on this one. Corteva here, DuPont and Dow have all been working to come back a little bit. Some underperformers in the portfolio, that's fine. It really gives me that materials sector exposure that I'm looking for. Chevron has kind of the cornerstone for the oil. I think it's the only oil exposure that I have in this portfolio. Glad to seek that through Chevron. High dividend payer, good quality, top 3 as far as I'm concerned. And then we drop down here to Duke Energy. This is a new position in this portfolio. Wanted to add a single utilities payer. I'll probably add Southern Company to the other one. and that'll round out my single stock exposure to utilities with Duke, Forties, and Southern Company. I do like 𝗋𝑎 on that list as well, but we own that through the ETF from Vanguard for utilities exposure. Facebook is the new position here. This is a relatively small position, which is fine. I didn't want to get overexposed. There's some headwind here for Facebook, but behind the scenes, they're doing nothing but generating money. So we own both of the ad revenue spaces here online. It's just an area of the market that I want to have exposure to, and we're satisfied to do that here. You can see here the new position in Google, 4 shares, nothing crazy. It's a big enough position. Shares are, $1,300 a piece. So this was kind of the icing on the cake. I discussed this a little bit on the live stream when I rolled out this pick in this portfolio. Just a company that I had to have exposure to, and it fit well into this portfolio. Right above it, General Mills for some dividend exposure, some staples solidification, and went ahead and added that in there. That adds a little bit more to the bottom line on the dividend. Home Depot as well has taken a little bit of a leg down. That's fine. We'll continue to own Home Depot. Honeywell, which is the complement to the UTX position in the other portfolio. Just an excellent company. I'm glad to own this long term in here. And then Intel was a clear out, and I rolled this into the other portfolio for strategic reasons. I took a pretty big trading profit in Intel in here, and then was able to roll those profits into some of the other holdings that you're declared. So this partial dividend will clear out of there. The $15 will go into cash, and that position will carry on and be allowed to work in the other portfolio. JP Morgan Chase has just been an awesome #1 bank in my portfolio as far as that's concerned. It's been a nice performer. One of the stocks it's on my top 5 list of stocks to own forever. JP Morgan, the #1 bank, largest bank in the world. So we own that in this portfolio. It fits well. Kraft Heinz Food. We've got for dividend and staples exposure. Lowe's, I wouldn't normally have both of the home improvement stocks in the same portfolio, but that's actually, I hit buy and I didn't realize I was buying it in this account and didn't want to sell it. So I went ahead and went with it. It was fine. I own Lowe's for different reasons than I own Home Depot. I actually feel like Lowe's is a better stock buy, and I felt like Home Depot was the best quality between the two, but a little bit expensive on the shares. And obviously I was right there, as I misaligned my entry there in Home Depot, and I feel like Lowe's really stands a lot better chance of some upside potential. 3M had a great day here recently. I was down big in this position. I mean big. I think I was over $1,000 down in 3M, and that's just been allowed to work. Look at that, almost an appreciation of 1 share in the dividend reinvestment. So it's amazing when these good dividend payers are allowed to work and you don't pay so much attention to this underperformance over here. I think 3M will be fine long term. Merck has just been on fire this year. One of the secret performers in healthcare this year has been Merck. So just awesome performance. You wish they could all perform as well as that. That doesn't happen that way. And then Pepsi has also been just a silent warrior this year, performing quite nicely. This has been a position that I have not touched this entire year. I have not sold, nor have I added to this position in Pepsi, and you see what it's been able to do this year, up 15 bits there. Pfizer, was half tempted to take a double up in Pfizer. Pfizer's probably the best entry right now of any of the healthcare names that I look at. I've already got a nice sizable position in it. Don't really want to overexpose to the name, but if you were looking at picking up some healthcare exposure, I don't know if there's a better name in the sector right now that is worth looking at. outside of Pfizer with regard to the entry that you're getting at 38 a share. Raytheon in the defense sector, that's a strong position here. I wouldn't necessarily consider that a starting position, but it just goes to show how favorably I consider Raytheon tops of the list. It would go Raytheon, Lockheed Martin, and then Northrop Grumman, and I own all three of them. Just Raytheon in this portfolio. Starbucks got a little entry window here and took advantage of it. That's given me a little bit of pay dirt here to a little bit of insulation in the name. It goes back and forth between growth and value. I think sometimes the growth gets called into question. I don't know why. It does trade at a pretty rich valuation, so as long as they can keep growing, they'll be fine. The second that growth starts to decelerate, I think Starbucks is really going to go through a transition of going from higher growth to a little bit more of a growth and income name, but we're not there yet. So investors are going to continue to enjoy some capital appreciation there, as well as a pretty strong dividend from Starbucks. And then right below it, AT&T has been a nice performer this year. From the start of the year up, we'll continue to kind of just sit back. This is almost like one of those holdings that you can put in the portfolio and just forget about, just sit on the fat dividend. I almost look at this as a bond exposure, and I don't want to seek bond exposure in the Roth IRAs. So I would rather own an underlying equity, and AT&T and Verizon both fit the bill in this particular portfolio. I don't see where Verizon is. I know it's here somewhere. There it is. But it's got some capital appreciation under its belt as well, but also a nice 4% dividend to boot. So it's been nice. Toronto Dominion is the other Canadian financial company that I've owned. They've been slightly out of favor, which is fine. They both pay over 4% dividends and a price to earnings ratio that's somewhat anemic when compared to the rest of the industry here. So TD, Toronto Dominion Bank, and then United Health Group, a nice position there. I've traded this a couple times when it just got oversold in the 230s. Now we're going to take a long position in here. So we've got a little bit of buffer as far as the cost basis that I was able to achieve in United Health Group. And then Visa. Visa has probably been the flagship stock in my entire portfolio. I kid you not. Visa does not go down. It continues to outperform. What can I say? I'm proud to be an owner in this company. I've looked at MasterCard and I've looked at American Express, and I don't think Visa gets quite the love, even with it being a Dow component with the others. American Express, not MasterCard, but just an awesome company to own, just a money-making machine, and kind of helps solidify in the transactions space, yes, but considered a technology company nonetheless. So Vanguard small cap, this is the value offering here, or the growth offering, excuse me. So a nice fund here. It's been obviously on a tear. I knew small caps were going to outperform through the end of the year this year. Here's the flagship VOO ETF here. That's the largest position in here. It does represent a starting position in this portfolio as we're ready to take this into a downturn. If we get a haircut in the S&P 500, I'm willing to take this in and average down in the position. So you can kind of understand my defensive approach to that. And then Verizon we've talked about, and Wells Fargo in the financials. That's been a nice silent performer this year, up 10%. Waste Management, a starting position here, just a company that I wanted some exposure to. And then finally Walmart, which is a new position for me this year to kind of solidify the large cap names there. Just felt like that was probably the best in the retail space to get some exposure to here, to kind of offset the risk that we're taking in the Amazon position and the other portfolio. So with that, I will click on the portfolio brief real quick and allow you guys to sit through that for just a minute or so. So stand by just a sec. All right, so like before, I'll go ahead and just let you guys sit back and enjoy this one of many products from, now this is the other account, not mine, so don't be confused by that first little message there. But this is cool. I catch this every now and then to just get a snapshot of how things are going. This is how this one did. So nice. Yep, 2,000. So we've earned a little bit more dividend income in this one than the other one, up 28%. So that's cool. We'll go ahead and throw the benchmark on here so we can actually see. I don't know if we've outperformed in this one. I'm not sure. We'll check it. I think that we have, but we'll check. Yes, we have. Not by much, but we have a little bit. So that's good to know. We'll continue to allow the brief to play a little bit, and I'll stop it right before we get to the environmental governance section. So this is kind of cool. This allows you to get a little bit better idea in what's in the portfolio is actually allowed to work. So all the cash right now is outside of the retirement accounts. So Facebook was the top performer this year. No surprise there. It had a huge downturn at the end of last year, down into the 130s. So obviously an oversold condition there in Facebook. So this is interesting as well. I think this is a little bit misleading as well. I think we'll probably yield 2.6 on the total portfolio. So that's kind of what we've got there. And here's the upgrade and downgrades on all the equities that I hold. And then there's the governance score. So I'll go ahead and stop that here, guys. I really hope you appreciate this portfolio review. This may be the last single portfolio review that I do on the self-directed IRA number 2 before the year's end, and I'll do a comprehensive review and show you all the reports for the year end 2019. But with that, guys, I'll kick you back to YouTube. All right, guys, so we've come out of the portfolio review. This is the self-directed Roth IRA account number 2. Hope you enjoyed how I have strategically built wealth over time, how I look to seek out my exposure to the market. You're going to find a few themes in each of these portfolio reviews, some strategic goals that I try to abide by. Obviously, these latest reviews that I've rolled out have indicated my need to put a little bit more growth in the portfolio. There was some names there in the growth category that I wanted to aim in there, but for the most part, the majority of the holdings are major blue chip Dow components, big large cap stocks, and I get my exposure to the other markets, both international, emerging markets, and small capitalization through the use of the Vanguard ETFs. I'm glad to do that. The secret being not necessarily the makeup of the account, but to put those good quality assets that are super low expense, if not no expense whatsoever, and allowing those good quality assets to grow within the shelter of the Roth IRA that is of a self-directed nature. Guys, if it's your first time to the message, I want to hit the subscribe button, help us support the message that we're putting through. Leave your comments at the bottom of the video. Share this message with any of our young folks that need to understand that this option is in fact out there. Guys, thank you so much for tuning into the video, and good luck in your investment future.